Good evening. Today we are talking about real estate investing for beginners, specifically real estate syndication. You might be interested in real estate investing. You might have watched a bunch of my videos before and it sounds pretty good, but you're not sure what syndication means when the word comes up, and you're not really sure how things are structured for you as an investor. So that's what we are covering today, real estate syndication for beginners. And if you have any questions or if you'd like to get started investing in real estate, you can go over to callseth.com and we can set up a quick 20 or 30 minute call and talk about your real estate goals and where you want to go with real estate. So we were talking about real estate syndication. Now, syndication sounds like a fancy word, but once we break it down, it's going to be crystal clear as mud. So what is a syndication? Well, a syndication is really a pool of funds. So investors will pool their funds together to acquire a piece of real estate. Syndication is used in the TV business, but for real estate purposes, we're not talking about reruns of Cheers or Friends or other TV shows. We're talking about acquiring real estate. So here's all of our investors over here. And individually, you know, these investors could be business people, lawyers, sales professionals, you know, technicians, whatever you need, whatever you want to call it. They have money to invest, and on their own, they might be able to acquire a small piece of real estate. But if they pool all of their funds together, they're able to acquire a much larger piece of real estate, which, as you know, if you followed the videos, gives off more cash flow. It's a lot more stable. You have better management in place, and you get better debt when it comes to financing the property, because lenders want to lend on these big deals more so than the smaller residential deals. Plus, all of these investors here, these professionals, they might be the world's best lawyer, the world's best brain surgeon. They don't have time to start researching real estate markets, how to properly underwrite a property. They don't know how to deal with tenants, but that's not their job to. Their job is to contribute to society, do a great job, and earn a great living doing what they do best in their day jobs. They shouldn't have to start a second job just to invest in real estate. And this is where the syndication comes in, because these investors will pool their funds, and then somebody called a general partner will come in. And the general partner is a person with the real estate experience. They have the team, they have the track record, they have all the connections, and the general partner will be able to take those funds and acquire a piece of real estate and then go through the business plan and all of that stuff to earn a return for the investors. And we'll explain that in a little bit more detail coming up. I really need to find a new ledge for my eraser. I'm trying to balance it right here. And almost every single video, it always falls off the ledge. So I'm going to have to come up with a solution. Maybe I'll have a little necklace, an eraser necklace, and I'll just carry it around this way. So who invests in a real estate syndication? Well, that's a very good question. And I'm going to give you a very broad answer because there's a couple different peculiarities, that's a tongue twister, to go through depending on how the deal is structured. So we know the syndication is a group of investors who pool their funds and put those funds in the control of another person to acquire a specific piece of real estate. I should mention that if investors pool their funds and for the purpose of acquiring multiple pieces of real estate within the same entity, that is a real estate fund, not a syndication. But since today we're talking about beginners, we're going to stick just with a real estate syndicate. So we're talking about acquiring one piece of real estate. But if you do want to talk about funds, hop on over to callseth.com and we can chat for 20 or 30 minutes about your real estate investing. So who invests in a syndication? Well, we're going to let's talk about 506B. Forget Reg A, forget 506C. If you've even heard of these terms, we're going to keep things simple. So, accredited investor. Who is an accredited investor? Well, that's a person who earns $200,000 a year plus for the past 2 years, or as a couple, they earn $300,000 a year. Oh, okay. Or they have $1 million in assets excluding their principal residence. So it has to be beside your principal residence. You can't count your house. So this is who an accredited investor is. And typically, depending on, there's different structures, but typically most syndicators, so the people, the general partners doing these deals, will approach accredited investors to bring in their funds to these deals and earn a return, get all these tax benefits, all the other advantages that come with investing in multifamily real estate. So these are accredited investors. So typically we'll see lots of doctors enjoy this, lawyers. Actually, there's quite a number of lawyers who see the potential in real estate. Lots of real estate lawyers actually end up as passive investors in syndications. We have lots of tech ladies and gents coming in too, very well-paying jobs, and that's a skill I have not mastered and I never will. I'll stick to real estate. We also have business owners. And again, this isn't an exhaustive list, but again, to meet the accredited investor criteria, you have to earn $200,000 a year for the past 2 years, or as a couple, $300,000, or have $1 million in assets. And the whole reason this was set up, actually, I did a live stream on this, but some scammers back in the day, back in the old-timey days, were going around scamming people with these made-up investments, not real estate specifically, but all these other things. And the government stepped in, and the government felt that if you were making this amount of money, you could absorb a bad investment and it wouldn't wipe you out. So we've got the Jobs Act and all that stuff. But again, I'm keeping it simple today. I'm not going off on a tangent. We are talking about real estate syndication for beginners. So these are the types of people who will invest in a syndication. And if you have questions, or if you are an accredited investor and you want to start investing in real estate in these large commercial deals, just head on over to callseth.com and we can have a quick chat about it. So what is the structure of the syndication? Well, we have two sides. We have the LP and we have the GP. So the LP is going to be the investors. These are your doctors, accountants, lawyers, business owners, programmers, all of that stuff. These are the investors that have put their money in and have decided that for this specific piece of property, they're going to invest. And the whole way the general partner approaches these investors is the GP. So the general partner will be the person controlling the deal. So I'll say control. And they have the experience. And they have the team. And they have the track record. Track record. So what will happen is the general partner will recognize an opportunity in real estate. They'll say, hey, this deal looks really good. I see lots of potential with this. I need to now put this deal under contract. And once the deal goes under contract, the GP will approach the limited partners, the investors, and say, hey, listen, this is the deal I have. We've spoken before. You know my game plan with these types of properties. This is how much capital we will need. These are the expected returns. This is what I want to do with the property. This is our exit. So this is when we're looking to divest or sell the property. Do you want to invest? And the investors will think it over. And if the deal looks good and fits their parameters and their goals and what they want to do, they will invest their funds. And the amount of the investment will vary depending on the GP, the deal, etc. So the investors have put their money into the syndication. They have invested. Now the LPs, the limited partners, they enjoy lots of protections under the law because they are not deemed to be experts in real estate. That's the general partner. So there are a lot of advantages to being a limited partner if the deal goes south. For instance, let's say the property, the mortgage defaults, they stop making payments while the general partner is on the hook there. The LPs are protected because they're not deemed to be experts. They're not active in investing in real estate. They've just put their money under the control of a real estate expert to go out and earn a return for them. So lots of advantages there. Plus you have all the tax benefits. You can basically wipe out a large portion of your tax through depreciation and cost segregation. I've done another video on that. So this is how a syndication is structured. You have the two sides. You have the LP and GP. And I will draw a piece of the pie. Actually, yeah, we'll do a pie today. I'm always a fan of pie. Cherry pie, blueberry pie. There was actually a really good pie from a place down the street called Mutual Pie. And that was a mix of cherry pie, blueberry, and they had some other stuff in there. Really good stuff. All right, so this is our syndication. So the investors will own, so the investors don't really buy a piece, they don't really buy the property, they buy shares in the entity that holds the property. So that this is our, let's say it's an LLC, or you can have an LP, we won't get into that stuff. That's just different structures. So let's say the general partner has the deal and everything pencils out and the investors will be earning a very good return. In exchange for the general partner's work, experience, management of the property for, let's say, the next 5 years, the general partner, here, let me get rid of this so it's not confusing. The general partner will get, let's say, 30% of the deal on the back end, so it's 30% GP. In exchange, so this is for the general partner's hard work, their guidance and all of that stuff. The investors, for bringing the capital that makes the deal go around, they will be getting 70%, split amongst them, obviously, in proportion of the deal. And there's something called a preferred return. So a preferred return is really a way of aligning interests between the limited partner and the general partner. You always want to make sure everybody's on the same page, striving for the same goals. Whenever on my podcast, I interview lots of successful real estate investors, and usually when there's a breakdown and there's obviously a good story that goes along with that, whenever there is a breakdown, it's because people weren't aligned with their interests. So one person was able to make money one way, but to the detriment of another party, and the deal wasn't structured properly. So a preferred return is a great way of aligning interests. So a preferred return, also called a pref for short form. Return. So preferred return says, listen, we are expecting this deal to pump out 10% on your money a year. But in order to make the general partner, so the person running the deal, produce, the LPs, the limited partners, are going to get the first 8% of that. And the general partner, the GP, will only be able to participate once this threshold has been reached. So think about it this way from a passive investor side. The general partner, the person who's responsible for making this deal work, they're not able to share in the profits of the deal until the investors are paid their 8%. This is a really good setup because the GP has to work really hard not only to hit this threshold, but if they don't hit it, the GPs don't get paid. So there's a lot of incentive there to make sure the deal performs for the investors. So if you ever see preferred return or pref or pref return thrown around, this is what it's talking about. It's talking about the LPs, so the limited partners, the passive investors, basically get first dibs on profits just to make sure that the GP is working hard on the deal. And if you have questions about preferred returns or anything like that, head on over to callseth.com and we'll set up a quick call for that. So how do splits work? Well, we were just talking about splits in general, but this is there's really a couple different ways that you make money in a real estate syndication. So one, you have cash flow, and then you have your equity, or I'll just say divestment because it sounds fancier. So as you're holding the deal, so let's imagine this deal is being held for 5 years. Over the 5 years, there's going to be cash flow being spit out by this property, and the investors are going to be getting monthly or quarterly checks. I always like to do monthly, but quarterly works as well. That's pretty standard. So the investors are going to put their money in, they're going to be earning a return, and the cash flow is coming off the property. And if it's an 8% preferred return, so they'll get their 8% before the general partner does. And then anything in addition to that will be paid out based on the split. Let's say it's a 70-30 like we used. So once the investors earn their 8%, that's good. And then everything else is calculated to make sure it's a 70-30 split. Now, divestment, this is where the big payday comes. The cash flow is good. It's going to give you your monthly checks, your quarterly checks. as you hold the deal, but you're going to be doing what's called a value add play. So you're going to be looking for opportunities. The GP is looking for a property where there's underperforming rents, potential for renovations. You can add storage facilities, you can add parking, you can add valet trash service, all these things to improve the income on the property. The great thing about commercial real estate is the property is valued based on the income approach which rewards net operating income. We'll cover that a whole nother video because I'm keeping things basic right now for beginners. At least I'm trying to. I tend to go off on some tangents. So we have the cash flow while we're holding the property. Then when we sell, there's going to be a big chunk because we've increased the value so much on this property. So again, it's going to be paid out based on, I'm just using this as an example, but a 70-30 split. So 70% of the back end will go to the investors and the 30% will go to the general partners. The syndication setup is really a great vehicle and a great way to make sure that the investors are protected and the general partner is rewarded for their experience and their game plan and actually executing on that business plan to ensure the investors are getting a return. The GP doesn't get paid unless the investors are getting paid and the deal's hitting the targets. Plus the investors are getting protected for anything going wrong because the GP is basically on the hook if something does go wrong. So syndicating is an amazing way for, let's say, your successful business owner, lawyer, accountant, programmer, you name it. If you are successful earning over $200,000 a year or $300,000 as a couple, or if you have $1 million plus in assets, you can really take advantage of this and invest in these large real estate deals that would normally be out of reach. But you're able to participate and earn the great returns that come with owning these commercial properties without any of the risk and without having to learn a whole new business. Because let's face it, coming up with the knowledge, the track record, the team behind you, the contacts, even getting in front of real estate brokers and having a shot at the property, that takes a lot of clout. And if one person, if I'm a brain surgeon, one day I decide to buy a $40 million asset, chances are I'm going to be back doing some more brain surgeries before I can acquire a property. But same thing with the general partner the general partner is focused on real estate. There's no reason for them to open up a law firm. So you want to stay within your lane and become an expert at that. So this is what syndication allows people to do. Allows them to get access to these large real estate deals, participate in the tax benefits, the cash flow, the appreciation, and all the good things that come with owning large commercial pieces of real estate. So I hope that clarified real estate syndication, especially if you're brand new to the term and you're not really sure what it means. But just keep in mind, accredited investors typically will be approached to invest in these deals. 506B would be the legislation that falls under. But there are other ways for non-accredited investors to invest, but I will save that for a totally different video. So if you do have any questions or if you think this real estate investing thing sounds pretty good, head on over to callseth.com and we can hop on a quick call and talk about your real estate goals. Thanks a lot and have a great night.